Welcome to This Explainer. Today, we're tackling a fascinating and honestly wildly disorienting financial phenomenon. So, I want you to imagine hitting a net worth of roughly $400,000 to $600,000. You've done absolutely everything right, you've grinded, you've saved, you've invested. But then, suddenly, you hit this invisible wall. Literally everything you did to get to this point suddenly stops working the exact same way. It's what we call the middle-tier wealth paradigm shift, and it is a massive mental hurdle. Mainly because the rules of the game have entirely changed right beneath your feet. Okay, let's dive into this. If you're currently in this bracket and you're feeling a bit lost right now, I want to explicitly validate that feeling for you. It is completely normal. In this explainer, we're going to lay out a clear roadmap to help transition your mindset from being a wealth builder to a wealth manager. We'll be looking at how the math flipped, clearing the wealth fog, the moving goalpost problem, invisible lifestyle creep, and finally, the new risk reality.
All right, let's jump right into Section 1, the math flipped. Growth over contributions.
Now, this is perhaps the absolute most powerful realization of middle-tier wealth. There is an exact moment when your money starts working harder than you do. Let's say you're hustling hard, you're maxing out your accounts, and adding a massive $40,000 a year. That is an incredible effort, but here is the secret shift. At a 7% average return, once your portfolio crosses roughly $570,000, the market is generating $62,000 in growth. The math has secretly flipped on you. Without you doing a single thing differently, your portfolio is now officially out-earning your physical contributions. And this brilliantly illustrates the massive psychological shift you have to make now. See, for years, you were in hustler mode. Your net worth moved because you moved. You got a raise, you picked up a side gig, you ruthlessly slashed expenses. But now you have to transition into caretaker mode. Your primary job is no longer generating the money, it's practicing restraint and simply not messing it up. And honestly, nobody trains you for this. They train you for the hustle, they absolutely did not train you for the patience, and frankly, the boredom required to just sit on your hands and let your money grow. So that brings us to Section 2, clearing the wealth fog and figuring out the next goal. Entering this caretaker mode comes with a surprisingly heavy emotional toll. You're no longer surviving paycheck to paycheck, which is great, but you are nowhere near the finish line of retirement. You're just stuck in the middle. I want you to just let this quote sit for a second. More isn't a goal, more is a treadmill. Think about it. When you were building your emergency fund, the goal was crystal clear, right? Save 3 to 6 months of expenses. Done. When paying off debt, the goal was zero. But at $500,000, what exactly is the goal? Just wanting more is incredibly vague, and frankly, it's a dangerous mindset that leads straight to burnout. Now, what's really interesting about this slide is that you actually have the antidote to that fog right in front of you. You need a concrete mathematical mile marker. Look at these options, and I want you to pick one right now to write down. Option 1, a solid round number milestone, like $750,000. Option 2, aim for your portfolio to cover 40% of your current expenses. Or Option 3, the 25x rule, multiplying your annual spend by 25 to find your true north. You see, the fog of the middle tier doesn't lift because you suddenly feel motivated. It lifts because you create clarity with a tangible target. Moving right along to Section 3, the moving goalpost problem. Let's talk about the comparison trap. This is the cruel irony of getting wealthier. You would think that having more money makes you feel more secure. But in reality, as your net worth increases, your social comparisons actually get significantly worse. Look, having $500,000 feels like an absolute mountain of wealth, right up until you meet someone sitting on $2 million. When you only had 10 grand saved, you weren't hanging out with millionaires. But crossing into that six-figure plus range means you start running in entirely new circles. You're at country clubs, reading advanced investment forums, or talking to friends who just sold a company. In that new context, your genuinely impressive progress can suddenly feel painfully small. Psychologically, we humans are hardwired to compare ourselves to whoever is exactly one step ahead of us. But comparing sideways, looking at a stranger's curated highlight reel, is a complete trap. The only comparison that actually contains useful, actionable signal is comparing backward. You have to measure your current trajectory against your past self. This year's you versus last year's you. For sure, that is the only way you stop the goalpost from moving. Let's move to Section 4 and see how this builds into invisible lifestyle creep or justified erosion. Because as you hang around those new circles, your spending habits are going to be tested in ways that feel completely justifiable. At the $500,000 mark, overspending doesn't look like buying a yacht you can't afford. It looks like a series of small, earned upgrades. A nicer car, pricier dinners, paying to upgrade your flights. You worked hard. You feel like you deserve this. But look at the math here. Just $200 a month in these tiny I deserve this upgrades equates to $60,000 over 15 years if invested. Actually, scratch that. It's more like a silent wealth killer. Nobody blows up their wealth with one bad decision here. They quietly erode it with 20 small ones.
So the crucial point is how we actually defend against this. You have to stop tracking the fixed dollar amount you save and start tracking your savings rate instead. If you're saving 30% of your income today, your job is to fiercely protect that exact percentage when you get your next raise. Do not let it quietly slide down to 15% just because your lifestyle absorbed the new cash. A rising income with a shrinking savings rate, that is not progress.
Finally, let's wrap up with Section 5, the new risk reality and the emotional weight of your money. This is the highest stakes shift of them all. Let's rewind a bit to the $50,000 mindset. If the market takes a standard 10% dip, your portfolio drops by $5,000. Now, is it annoying? Yes, absolutely. But ultimately, it's forgettable. You can hustle, do a few months of tight budgeting, and make that right back up. But when you have $550,000, that exact same 10% market drop is a massive $55,000 loss on paper. I really want that number to just hate you for a second. It is the exact same market behavior, but it carries an entirely different emotional weight. It literally feels like losing an entire year's salary overnight.
And this is exactly why those aspirational risk tolerance quizzes you take online are essentially useless at this level. You don't need a quiz. You need an honest gut check. Ask yourself, what did you actually do in 2022 during the last major downturn? Did you hold steady? Did you panic sell? Or did you just delete your investment apps and stop checking entirely because you were too stressed out?
See, your true risk tolerance is written in your past behavior, because having the mathematically perfect asset allocation on a spreadsheet is completely and utterly worthless if a 20% drawdown ruins your sleep and forces you to sell your aggressive assets at the absolute bottom. You've got to build a portfolio you can actually sit through when things get rough. Which leaves us with this final, incredibly important question to ponder. Will your current wealth strategy survive your next big emotional test? Because succeeding in this 500K paradigm isn't about working harder or hustling more. It is about fundamentally changing how you manage the emotional weight of your money. Take these concepts, apply them to your own portfolio, and take control of your financial trajectory. Thanks for joining me for this explainer, and keep learning.